Hello and welcome to LiveSquawk's Market Talk on Thursday, the 11th of September, 2025. Today's episode will be previewing the ECB Interest Rate Announcement due at 12:15 GMT. Helping me to prepare for the announcement, I'm joined by Guenter Grimm, Market Analyst and Portfolio Manager, and LiveSquawk's own European Editor, Eric Culp. Welcome to you both.
Hi guys, thanks for having me.
Greetings from Frankfurt.
Awesome. Before we get into it, a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. Right, so if we get into it now, we're a couple of hours before the interest rate announcement itself. Just a quick note here to give you some sort of framework. We had a note from Nomura. So the announcement, as I said, 12:15 GMT. They're expected to keep rates on hold. Economists at Nomura wrote that with ECB's deposit rate at 2%, the midpoint of its estimated neutral range of 1.75% to 2.25%, and inflation close to target while GDP growth tracks trend, the central bank is well placed to weather US trade policy uncertainty flagged by President Lagarde in the June and July meetings. The bank expects the ECB to leave the deposit rate unchanged at 2% at its meeting on 11th of September. I'll also give you a quick note from Eric here, who says he's written a preview ahead of today's announcement. Says ECB set to hold rates again, is steady on the new mantra. Many analysts say cut cycle is over. Growth risk could spur another reduction though. Staff scheduled to update forecasts. And then we have the press conference obviously later on today at 12:45 GMT. 14:45 Central European time. Eric, do you want to give us a quick preamble then of what we're looking for from today's announcement?
Sure. Everybody and their brother seems to think it's going to be a hold, and I think that makes sense. They're talking about being in a good place. And I don't see any reason for them to say, yeah, we're not in a good place. We need to cut again. There's so much going on right now with inflation, just over the target. There's no need to act. It's I think one of the problems with the growth information, it's still unclear. You get mixed signals. The German business confidence reading from IFO, it hasn't fallen at all this year. It moves sideways 1 month. Everything else has been an increase even after the EU and Washington decided on the trade agreement, which has a lot of companies here really angry. And I think they're kind of, gritting their teeth about taking these lumps, which, a year ago they would all laughed in people's faces saying, yeah, there's no way that's going to happen. That said, that's going to be probably what drives any change in policy in the future. But I mean, you have a lot of, both Deutsche and Danske Bank are saying nothing until at least the end of next year. And that's a long horizon.
Thanks, Eric. Guenter, in terms, actually, before I do that, because it is, if the rate announcement itself is a done deal and everyone's pretty much prepared to accept that we're staying where we are, it becomes then about, I guess, for today's meeting at least, the updated set of forecasts in there. And I just want a quick note here from JP Morgan on their views on this point. They say new staff forecast should frame the debate. Forecast changes are likely to be small, but should maintain an easing bias. The growth has surprised the ECB on the upside, but in a nuanced way. The GDP growth forecast over the first quarter 2025 through to Q3 averaged at 0.6% in the June forecast, including the front-loading payback assumed for Q3 2025. And we'll come into the payback and what that means. But the first half of the year growth details make the case for Q3 much less compelling, with Irish GDP holding up due to normal noise, despite payback materialising on pharmaceutical exports. We suspect that staff will no longer expect a GDP contraction in Q3 of this year. On the inflation front, the data have been close to the staff's June projections. Headline inflation is tracking at 0.2%, percentage points higher at 2.1% on the average in Q3, but core inflation is in line at 2.3%. Again, looking at some other notes here from ING, they say their fresh round of ECB projections should bring a slight downward revision to inflation and growth for 2026. So you just frame it there with some of the bank notes that we have. Guenter, any views initially on today's decision, but then we look at the wider forecast as well?
Yeah, sure. So as Eric says, no changes baked in the cake. And it will be interesting to see what the staff forecasts will look like, growth and inflation. My personal view is that the risks for growth are more biased to the downside, and for inflation, actually also to the downside. And my big picture view is that comes from abroad, from the Fed basically, where I think the Fed might surprise with more rate cuts than what's currently priced in. I think there's also a lot of political pressure on the Fed, as we know. And now we had the data also confirming, maybe not so much the inflation data, but the labor market data. And I think that's the main worry for the Fed at the moment. And they will overemphasize that input into their decision-making process. And therefore, I would not be surprised if we see a 50 basis point rate cut at the next meeting in the US. That could mean, hasn't happened yet, that the dollar could continue or should resume its downward trend. So continue to weaken. At the moment, we're going sideways. If you look at euro dollar or dollar yen is also very sticky. But big picture, I think the dollar will continue to weaken. What that then could mean for the euro dollar is that we go higher in euro dollar. That will take off the inflation pressure in the Eurozone via lower import prices. It will hurt the export sector and therefore the growth outlook. And then the ECB might change its view and will probably sound more dovish and resume their interest rate cutting cycle.
That's interesting then. So you think there's more outside influence really from the US decision itself based on the effects it might have on the currency overall, and what that will effectively do to the central bank's thinking and models, basically.
Yeah, they won't admit it, but I think looking from top down, that's my big picture view. Yeah.
Yeah, that was my question to Eric. Actually, they don't like mentioning the currency, and I know she's been pressed on it previously, Lagarde. Do you think that will be something she might open up to? I mean, she might want to frame today's meeting for the back end of this year, I guess. Do you see any possibility that she might give a bit more away than normal, Eric?
You know, it's really hard to tell with her. I'll say it, I think she's a bit of a loose cannon sometimes when it comes to talking about policy. And I'm sure the people at the press department there are pulling their hair out sometimes. Also on the executive board and the governing council. I think it's a really good point that Guenter makes about rate changes in the U.S. I would counter that. I think it's hard to tell what the plans of the European Union and Germany to build their militaries up, because the EU came out this week with talking about big projects too. That's all internal growth, but they're still going to have to make imports, steel and other raw materials to build up their militaries. So yeah, I get where he's going with that, and I see that it makes sense. When it comes to Lagarde and talking about the exchange rate, I mean, that's really a hot button issue for U.S. President Donald Trump. And as soon as any leader in any currency area starts talking about their currency, I mean, he's going to hit that with the biggest hammer he can find. So I think politically, she probably would try to skirt it because she's pretty cagey.
Yeah.
Now, whether or not she feels that they need to talk about it, you never know.
Okay, good points there on both sides from the import perspective as well. Obviously, we've seen this week what's happened in Poland. Anyone who may have missed it because they were locked in a cupboard. Russia's been probing the vulnerabilities of NATO, I guess, and their reaction function with a number of drone entering the Polish border, over the Polish border, really, and just provoking NATO, not to the point where we get to an Article 5 situation where it would trigger any action, but just the experts say to see how far they'll go. But what it will do, I mean, Poland's already said it's going to hit 5% in terms of its defence spending. It may prod some Eurozone members to maybe promise a little bit more than they currently have as well, but that's probably a bit of a stretch. Getting back then to today's ECB decision, or more importantly, what we're likely to see in terms of, again, forward guidance and expectations for down the line. Guenter, just in terms of where we go then, what are we, if we take today's ECB as a washout in terms of real activity for traders and investors, what are you looking for in particular then?
Can go back to the chart when I
The previous one.
data. So
Yeah.
what it describes here is the interest rate path of the short end expected by the market.
Okay.
And so we see now currently, because we have no change expected at around 2%, and then a chance of maybe another rate cut, but not fully priced. And then from 27 onwards, or mid 27 onwards, back to 2%, and then a further increase to, let's call it 2.5%. So I think the surprise could be that this rate hike path from mid 27 onwards is maybe too optimistic, especially. I'm really thinking big picture here, and of course I can be wrong with my dollar view. It is a bit binary, I have to admit. But should the dollar continue to weaken, and I really think that's the Trump's policy goal, Trump's administration's policy goal, then there will be deflationary pressure or deflation in the Eurozone. And we also have to think about China. This whole discussion about overcapacity, where they try to dump their goods in other jurisdictions where the tariffs are not as high or even non-existent. And so that also puts a disinflationary bias into the Eurozone. You mentioned fiscal policy, that's a plus for growth. I'm not sure if it overcompensate for the shortfall there may be in the other sectors. Also, small anecdote, I'm living here in Switzerland, as you know, small open economy, and they're worried about the labor market here. They're discussing a law to extend the short-term work projections. So if you're a company and you have a shortfall in demand, you can then apply for short-term work contracts. So the government sponsors basically your employee. So they're really concerned here, and maybe that's the canary in the coal mine, also for other areas like the Eurozone.
Yeah, if I may, I think you're right about a lot of that. There's already reports of Chinese goods making their way to Europe. That's one issue, and I think the other thing is, I don't know if any bank can really say that the European Central Bank is going to, or any analyst can say that European Central Bank is going to hold for the next 2 years. Right? It's just way too far out. As I wrote in my article, just look at what happened this week, right? And then whether it's the drone attack the Russian drones in Polish airspace, that's what we know according to their media, right? That's one thing. You had an assassination yesterday in the United States. You have Israel attacking Qatar. I mean, there's a lot happening right now. So I think there could be another cut. I think most analysts, they're not going to rule it out, right? Whether it's ING or Deutsche or Danske or in general. But if anything happens, it's going to be a cut, probably because of growth.
So, Guenter.
If I might add the French politics variable is quite interesting. So if that escalates, no government, fiscal spending still out of control, market getting nervous about French bonds selling off. What will the ECB do? You might have contagion into peripheral bond markets again. will then buy Italian bonds and so on and so forth. That doesn't fit with the rate hike, which is implied in this path here.
Yeah, and
exactly.
that was my point. I was going to ask about is France an issue, and so you've answered my next question on that front there. Obviously, it's calmed down a little bit, but we are, France now needs to put together another government, and as the second largest economy, how much would that weigh? And this is an open question for either of you. How much would you think that weigh? Firstly, on the ECB, and secondly, on investor confidence in the area as well, and subsequently, whether they'd want to hold euro-denominated assets at the moment. So I'll ask Eric first on that one. Do you think, as a journalist, would you be asking a question about the vulnerabilities of France at today's press conference?
Of course, and I'm sure someone will. I think she's savvy enough to skirt it to some extent, but her connections to her home country and her perhaps access to members of the government members of the government or members of the opposition may prod her into making some comments about it. I think you make a good point about you already have Germany. It's sideways to lower, right? France also looking weak. Italy looking weak, and also political issues in Italy. So at the end of the day, the only economy that you'd say, yeah, I'd invest in that right now, among the four largest in the European Union, is Spain, right? And they're showing growth, and it seems to be going okay at the moment there. But in general, it's meh. That said, there's also a lot of concerns about growth in the U.S. too. So it's hard for an investor to say, yeah, you know what, I'm going U.S. denominated assets right now, or dollar denominated assets. But then you look at the stock market in the U.S., like, yeah, I'm playing that game. I'm playing that game.
Well, it looks like they're looking at different things. So the stock market's getting ahead of the game, and the bond market's saying maybe something slightly different. But it's an interesting conundrum at the moment. Looking at the forecast, then, as we've kind of got in Guenter's notes from JP Morgan, their star forecast expected to maintain an easing bias. This is JP Morgan's. Obviously, I read from ING a little while ago that was we're looking for a slight downgrade. And I think JP Morgan say the outlook marginal downward revisions in near-term quarterly growth. Annual averages lifted only by past outturns and Ireland. And on the inflation front, stronger currency and China's deflation pressures point to lower core inflation in 26-27. Core inflation forecast likely remains at 1.9% year on year. Again, we're going back to the investor and trader's point of view. Is that where you'd attach the most importance today, Guenter, in terms of your reaction function and whether you get involved in trading around today's decision?
Yeah, if they were to become more skeptical about the growth outlook despite the recent tariff agreement, because I sense that, as you also mentioned, companies are not happy, and here in Switzerland even less so, because we have, I think, a tariff rate of 39%. So there's clearly risk to the growth outlook. And I looked at the DAX this morning. It's has topped out a bit. I'm not making any prediction, but it's weakish, I would say. And now you have the French problem, although I'm surprised that the CAC is not lower. And then, as I said, on inflation, I'm also more negative, so lower. My personal inflation outlook is lower than probably what's priced in currently, because I see downside risks there.
Okay, cool. Okay, so not fresh, but if we look at the wider issue then around Europe, let's have a quick look at the next slide here. Scenarios for the September ECB meeting then, and just in terms of how she'll term it, we're not going to beat a dead horse on this one. We know today's decision in itself is unlikely to be anything exhilarating, and Lagarde's put me to sleep on many occasions during her press conference. So I think, Guenter, you kindly put up a couple of potential scenarios here. So do you want to walk us through briefly what they're saying on this front?
Yeah, so when it comes to growth and inflation, I'm more in the GS camp. So I see the dovish risk. The hawkish risk is, of course, the opposite, that growth is more resilient, sorry,
Mm.
and will actually accelerate from here. And with regard to the projections, if I would say if they actually down or revise growth downward, that's even more dovish than what Goldman says, growth unchanged in 27. Of course, if opposite again, we have seen upgrade in the growth outlook, that would be seen as more hawkish. And regarding the language, policy language, if they hint that maybe the risk is to the downside, so confirming my view, yeah, that would be very dovish. If they come across, yeah, we are data dependent, we are neutral, we are in a good place, then the market might see this, yeah, as neutral, shouldn't react that much, or maybe slightly, yeah, hawkish, and you could see the short end reacting a bit, and maybe euro dollar go a bit higher. So yeah, but I'm more in the dovish risk camp.
And Eric, anything that you see there that in terms of scenarios that strikes you?
No, I think it looks like they have all the bases covered here. To me, I think what's coming is more important than what's happening right now. For example, next month's ruling, or when the Supreme Court rules on the tariffs, I think that is going to be a cat amongst the pigeons if they rule against it, because that changes everything that's been set up already. There's no one in Brussels who's going to be able to say, yeah, you know what, we're just going to keep this deal we closed, because if the tariffs are illegal,
yeah,
by American law, then they don't have to pay them. They're no longer in force. Then all of a sudden that changes the entire growth outlook. I don't know what's going to happen. All right.
Yeah.
The Supreme Court seems to be leaning toward the president, but that's going to change all these scenarios. So I think for the moment, these are what we have to work with. But next month.
Yeah, true. We do have a France Fitch looking at France ratings. Everyone's fairly sanguine about it, and that this is out tomorrow after market close. I mean, if they did put them on watch negative, for example, or downgrade them, that could really then just change the scenario. Like you say, looking forward, that could then change the scenario for the next meeting, and depending on what happens in the markets and whether we see another run on French debt and maybe even some of the more peripheral nations. Guenter, is that, if we were to get some sort of downgrade on tomorrow after market, would you be overly concerned?
Yeah. I think then it could set things in motion, and my confidence that they'll sort it out in France is not very high. But maybe too bearish. I'm usually too bearish, just to warn everyone.
Yeah, but look at the recent. We've had four different, I think 3 or 4 different prime ministers in.
Yeah.
So you're going based off of records, based off of history.
Yeah, and saying that, so a lot of people look at the spread between German and French 10-year bond yields, and that's now at 80 basis points. I would rather look at the Italian-French spread, because I think Germany, with this huge fiscal package, they've issued, maybe bonds are not that much of a safe haven anymore. So I would rather look at the French-Italian spread to see if things get better or get worse.
Sure.
In that regard, yeah.
Okay, awesome. We've come to the end of our time now, so I'd like to thank you both for your words and insights this morning. So just to recap, then we have this interest rate announcement due up at 12:15 GMT today, and then a half hour later we have the press conference there. Not looking for any change, keeping the deposit rate at 2%, and much of the language expected to be the same. Well, they get staff projections, update to staff projections, and it's kind of mixed. People say we'll see slight adjustments. ING looking for maybe slight downgrades to both growth and inflation, if I've read that right. And again, a bit more nuance there from JP Morgan, but on the whole, not too much of a change. And as such, should be the narrative to keep interest rates on hold and into the year end anyway. Again, guys, thanks again for appearing. This will go out pretty much in the next sort of 10-15 minutes, so everyone can have a listen beforehand. But anyone wanting to listen to the actual rate decision themselves, go to LiveSquawk.com. If you're not a member, take out a free trial and see if it's something that may help your trading day. Otherwise, have a good day, and we'll see you again for the next episode. Thanks a lot for listening.
Thanks a lot for having us. Thank you.
Always a pleasure.
Always a pleasure is what I was going to say.